Ever feel like you're trying to read a foreign language when you're learning about trading? You're not alone. The world of finance is full of confusing jargon and complicated concepts, but trust me, you don't need an economics degree to become a successful trader. In this video, we're going to break down some of the most common trading terms, from index funds to CPI, in a way that's easy to understand. We'll cover everything you need to know to start making sense of the markets and making smarter investment decisions. Because when you understand the language of trading, you unlock a whole new level of confidence and control over your financial future. So, whether you're a complete beginner or just need a refresher, this video is for you. Let's start with index funds, one of the most popular and powerful investment vehicles. Imagine trying to pick out the best individual stocks in the entire market. It would be nearly impossible, right? That's where index funds come in. An index fund is like a basket of stocks that tracks a specific market index, like the S&P 500. Instead of trying to beat the market, index funds aim to match its performance. This makes them a low-cost and diversified way to invest in the stock market, which is why they're a cornerstone of many long-term investment strategies. Now, let's dive into the world of CFDs, or contracts for difference. CFDs are a bit more complex than index funds, but they can be a valuable tool for traders who understand how to use them correctly. Essentially, a CFD allows you to speculate on the price movement of an asset without actually owning the asset itself. You're entering into a contract with a broker, agreeing to exchange the difference in the asset's price from the time you open the contract to the time you close it. CFDs can be used for both long and short positions, and they often come with leverage, which can amplify both profits and losses. Often used interchangeably, investing and trading are actually quite different. Investing is a long-term strategy that focuses on building wealth gradually over time. Think of it like planting a tree and letting it grow for years to come. Trading, on the other hand, is a more active approach that involves buying and selling assets over shorter periods, aiming to profit from short-term price fluctuations. It's more like flipping houses. You're looking for quick returns, but it also comes with higher risks. Both approaches have their pros and cons, so it's important to choose the one that aligns with your financial goals and risk tolerance. Forex trading explained. Ready to enter the world's largest and most liquid financial market? That's forex, short for foreign exchange. In forex trading, you're essentially buying one currency and selling another, aiming to profit from the fluctuations in their exchange rates. Think of it like exchanging currency at the airport. You're hoping to get a better exchange rate when you convert back to your home currency. Forex trading can be highly volatile and complex, but it also offers the potential for significant profits for skilled traders. Commodities trading, from oil to gold. Commodities are the raw materials that form the backbone of the global economy, from oil and gold to coffee and wheat. Commodities trading involves buying and selling these raw materials on exchanges, with prices influenced by factors like supply and demand, weather patterns, and geopolitical events. For example, if there's a drought in a major coffee-producing region, the price of coffee beans is likely to rise. Commodities trading can be volatile, but it offers diversification for investors and opportunities for those looking to hedge against inflation. Bulls versus bears, understanding market sentiment. You'll often hear the terms bullish and bearish thrown around in the financial world. They're used to describe the overall sentiment or direction of the market. A bull market is characterized by optimism and rising prices. Investors are confident, and there's a general belief that the market will continue to go up. On the other hand, a bear market is all about pessimism and falling prices. Investors are fearful, and there's a general feeling of uncertainty and negativity. Understanding these market sentiments can help you make more informed trading decisions. Short selling explained, profiting from a down market. Most people are familiar with the traditional buy low, sell high strategy, but what if you could profit from a falling market? That's where short selling comes in. Short selling is essentially the reverse of buying stock. You're borrowing shares of a stock you believe will go down in price, selling them at the current market price, and then hoping to buy them back later at a lower price to return to the lender. Short selling can be a risky strategy, as losses can be unlimited if the stock price goes up instead of down. The magic of compound interest investing. Compound interest is like the snowball effect of investing. It's the concept of earning interest on your initial investment plus all the accumulated interest from previous periods. In other words, it's interest earned on interest. The earlier you start investing and the longer you let your money compound, the more dramatic the results. Even small amounts invested consistently over time can grow into significant sums thanks to the power of compounding. It's like putting your money to work for you, allowing it to grow exponentially over time. Investment brokers, your gateway to the markets. An investment broker acts as a middleman between you and the financial markets. They provide you with access to trading platforms, research tools, and allow you to buy and sell a wide range of assets, including stocks, bonds, mutual funds, and more. Think of them as your financial Sherpas, guiding you through the sometimes complex world of investing. There are different types of brokers, from full-service brokers who offer personalized advice and manage your investments for you to discount brokers who provide a more DIY approach with lower fees. Choosing the right broker is crucial for your investing journey. Investing platforms, your trading command center. Investing platforms are the online tools that allow you to buy, sell, and monitor your investments all in one place. They're like your personalized trading dashboards, providing you with real-time market data, charting tools, research reports, and the ability to execute trades with just a few clicks. Choosing the right investing platform is like choosing the right car. You want one that fits your needs, budget, and level of experience. Some platforms are designed for beginners while others are geared towards more advanced traders. Averaging down, turning losses into opportunities. Even the best investors experience losses from time to time. It's a natural part of the investing journey. Averaging down is a strategy that can help you mitigate losses and potentially turn them into opportunities. When you average down, you're buying more of an investment after its price has declined, which lowers your average cost per share. This can be a smart move if you believe in the long-term prospects of the investment and are comfortable with the added risk. Buyer's market. A prime time to invest? A buyer's market is like a clearance sale for investors. It's a period when supply outweighs demand, leading to lower prices for assets like stocks, real estate, or even commodities. This can be a fantastic opportunity to snag great deals and potentially maximize your returns. However, it's important to remember that timing the market perfectly is nearly impossible. And even in a buyer's market, it's crucial to do your research and invest in assets that align with your overall investment strategy. CPI, understanding inflation's impact. CPI, or the Consumer Price Index, is a measure of inflation that tracks the average change in prices paid by consumers for a basket of goods and services over time. It's like a barometer for the economy, indicating whether prices are rising or falling. As an investor, understanding CPI is crucial because inflation can erode the value of your investments over time. By tracking CPI, you can make more informed decisions about how to protect and grow your wealth in a changing economic environment. Now you're speaking the language of trading. Congratulations! You've just taken a crash course in some of the most important trading terms. Remember, knowledge is power, and the more you understand the language of trading, the better equipped you are to navigate the markets and make informed decisions. But this is just the beginning. The world of finance is vast and constantly evolving, so never stop learning. There are countless resources available to help you deepen your understanding and stay ahead of the curve. What other trading terms are you curious about? Let me know in the comments below and I might just cover them in a future video. Don't forget to like and subscribe for more videos on personal finance, investing, and building wealth.